There are very few things that almost everyone agrees with in the world of personal finance and investing. However, one of those things is that diversifying your investments is generally a good idea. Well, almost everyone agrees with that, because back in a 2011 interview, Mark Cuban was quoted saying that diversification is for idiots. And what's interesting is that technically, for some people in specific situations, he may be right. Depending on who you are, what you want to accomplish most, and what your financial situation is, diversification could actually be downright harmful to your financial future. With that in mind, today we're going to be talking about diversification. We'll be discussing what it is in terms of investing, its pros and cons, why I generally think it's recommended, and of course, why it isn't for everybody. Let's get started. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So first things first, what is diversification in investing? To put it simply, diversification is the process of investing your money in a way that reduces the exposure to any one particular asset class. The idea behind it is to lower volatility as much as possible, since volatility is one of the most common ways to measure how risky an investment is, though it is by no means the only way. One of the most common ways to diversify your investments is to split your investments between stocks and bonds. This is because stocks and bonds are usually not very highly correlated with one another. In other words, when the price of stocks go up, the price of bonds often goes down, and vice versa. This isn't always the case, of course, but a lot of the times it is what's happened. To show you the impact of diversification, let's say that you had $100 to invest, and you put all of it into the stock market. Over the course of the next year, the value of stocks go down by 50%. Which would have been right around what we saw during the housing crisis of 2008. Your $100 investment would now be worth a mere $50. Not so great. But what if you had decided to put $50 of your original $100 into stocks and the other $50 into bonds? Let's say that during the same year when we saw the value of stocks plummet by 50%, we saw the value of bonds rise by 30%. In this hypothetical scenario, your original $50 investment in stocks would now be worth $25 because it still fell by 50%. But the value of your bonds would be worth $65. In total, your savings are worth $90. So even though you would have just went through what would have been one of the worst crashes in the history of the stock market, your total investment nest egg only took a 10% hit by the time the market hit bottom, because you didn't put all your eggs in the stock market basket. Now, a 10% drop in the value of our investments isn't necessarily what most of us are hoping for when we make them, but 10% is far better than losing 50%. And that's the value behind diversifying your investments. When it's done properly, it smooths the ride of your investments over the years by limiting the amount your investments are likely to fall should the worst happen. And this can have one hugely positive effect. With a smoother ride, people, on average, are going to be less likely to sell their investments every time we experience a correction or a crash. And as we've heard time and time again, time in the market beats timing the market almost every single time. Just as a quick hypothetical, let's take a look at John. John has had $500 a month to invest for the past 4 years. Usually, he invests all of it in a Vanguard S&P 500 index fund. However, he does tend to get spooked by market crashes. So whenever the market falls by 20% or more, he sells all of his shares and keeps his money in cash until the market fully recovers. Once the market has fully recovered, he invests whatever cash he's sitting on back into that Vanguard index fund, and he begins investing like normal once again after that. From 1980 to 2019, John would have accumulated about $1.39 million using this method. However, if John had just invested his $500 a month, as well as any dividends he picked up along the way, every month, regardless of what the market was doing at the time, he would have ended up with about $2.94 million. That's a difference of over $1.5 million in John's nest egg. So you can see why smoothing out the ride along the way can make a huge difference, especially if you might otherwise sell your investments during crashes. It's definitely a pro for diversification, and it's one that's worth considering. However, as we learned from high school science class, with every action, there's an equal and opposite reaction, and the same is true for diversification. Because while diversifying your investments can raise your financial floor, so to speak, by protecting at least a part of your savings from crashes, and potentially making you less likely to sell at or near the bottom of markets, it also lowers the height of your financial ceiling. because historically speaking, stocks have performed better than bonds over the long haul. Just to give you an idea of how much of a difference there's been, let's take a look at how Vanguard's Total Bond Market Index Fund stacks up against their S&P 500 Stock Index Fund. If you had invested $500 a month into Vanguard's Bond Index Fund from 2001 to 2019, you would have built up a nest egg worth about $156,000. Over the course of those 18 years, that's an average rate of return of a little under 4% per year. Had you invested the same amount of money over the same time period in Vanguard's S&P 500 Index Fund, you would have built a nest egg worth around $294,000. That's good for right around a 10% average annual rate of return. Hypothetically, if we stretch this out to a 40-year working career, you would have a nest egg worth about $580,000, assuming you invested solely in bonds. Or a nest egg of around $2.94 million, assuming you had invested solely in stocks, like we said before. Of course, those figures assume that you reinvest any dividends you receive, and they aren't adjusted for inflation. If we had adjusted for inflation, they would be a little bit different. For instance, from 2001 to 2019, inflation was estimated to be about 2.1% per year, according to the CPI. If we stretch that inflation rate out to 40 years, that means that by the time we're getting ready to retire, our bond investment would be worth right about the same as what $250,000 would be worth today, whereas our S&P 500 index fund would be worth about the same as what $1.28 million is worth today. So as you can see, if you're not going to sell your investments during a market crash or some other crisis, such as a job loss or a downturn in the profitability of your business or side hustle, you may stand to gain higher overall returns, again, over the long haul, by investing a larger portion of your money in comparatively more volatile investments, such as the stock market. And over longer periods of time, that can make quite a difference in your retirement's nest egg and the amount of income you'll be able to live on with it. So diversifying your investments will lower the volatility in most cases, but by definition, if you're putting anything less than 100% of your investments towards what you expect to be achieving the highest returns over time, you're going to be sacrificing some potential gains in order to get that peace of mind and lower volatility. Again, assuming you are someone who can legitimately ride those ups and downs both in the market and in life, that's definitely something worth considering. But when Mark Cuban spoke about how diversification is for idiots, he wasn't just talking about splitting your money between stocks and bonds. He zeroes his investments in even further than that. Instead of buying something like an S&P 500 index fund and owning around 500 companies, Cuban prefers to thoroughly research one or maybe a few companies, or other types of investments that are beyond the stock market, and put all of his money into those. In theory, this is a lot more risky than investing in an index fund like the S&P 500, but if the cards fall favorably, it could yield him much, much bigger rewards. Let's say that instead of splitting $500 a month between stocks and bonds, or even just putting all of it into an S&P 500 index fund, John had instead invested everything he had into Bitcoin, which is obviously an extreme example, but it'll help illustrate the general point Cuban is making here. Let's say that John did his research thoroughly and he began investing in Bitcoin in 2015 when it was valued at a little over $200. He put his $500 a month in every month, and by the time Bitcoin reached its peak of around $14,000 in December of 2017, his investment would have been worth over $513,000. That's an average rate of return of almost 375% per year. And yes, you heard me right, 375% per year. And I should note, because someone did bring it up in the comments a while back, I'm using data from Yahoo Finance here, which shows the average closing prices for Bitcoin each month. The commenter did let me know that Bitcoin's all-time high was actually closer to $20,000 than $14,000, and that is true. My numbers just showed about $14,000 since that's what Yahoo Finance's monthly average closing price for Bitcoin was. But yes, it did rise to right around $20,000 for its technical all-time intraday high. If we look at John's situation as it would have appeared in the middle of December when Bitcoin was closing at around $20,000 there for a few days, his investment would have been worth close to $725,000, which would have equated to an average rate of return of about 440% per year. Oh my gosh. Of course, Bitcoin would slide away from those highs, and as of this writing, in mid-November 2019, it's closing between $8,000 and $9,000. So if John had continued investing investing his $500 a month in Bitcoin even after the highs, his investment would now be worth around $325,000. That's quite a bit lower than where it was in 2017, but it still works out to be about a 109% average annual rate of return for John over the course of nearly 5 years of investing. If we stretched that 109% per year return out to 40 years, which I'm just going to say right now is almost certainly not going to happen, but if it did, John's investments would now be worth an absolutely staggering 55 quadrillion, 386 trillion, 947 billion, 883 million, $480,094.44. Wow. And I'll admit, the first calculator I used to try and figure that out wasn't even able to display the full results because they were so impossibly huge. But man, almost $56 quadrillion. That's crazy. Comparing that to the now very, very modest sounding $2.94 million we got by diversifying our investments in the stock market through an index fund, and you can see how big of a difference potentially ignoring the advice to be diversified in your investments could theoretically be. And I want to stress, theoretically. So, if there's such a potential windfall awaiting those who do ignore the traditional advice to diversify their investments, why is it still a practice that's so widely recommended? Well, in my opinion, there's a couple of reasons, but undoubtedly the biggest ones come down to our own behaviors and abilities to tolerate risk. After all, it's great to see that our portfolios grew to $500,000 or $700,000 over the course of a handful of years without having to invest thousands of dollars a month to get there, but it's equally difficult, if not more so, because most of us are at least a little risk averse, to see our portfolios crash from that $700,000 value to $300,000 over the course of just a handful of months. There's really a great lesson here to be learned, and it's that it's vitally important for us to stop and consider our own situation and our own goals whenever we get advice from others, whether the advice is financially related or not. Because some of us may be in a position where we're making enough money to comfortably support the lifestyle we want today while still having savings and investments to cover current emergencies and future expenses. Maybe at that point, such a person would be all right putting a good chunk of their earnings into a more speculative investment that might earn them triple-digit returns for a few years, even though they know it could just as easily cost them everything that they've put in. They're in a good enough situation financially where they don't really see that possibility of losing everything as much of a risk, because losing the money that they're investing now wouldn't hurt them that much. They're covered. But not everyone is in that situation. And in fact, the vast majority of us aren't in that situation. So most people would be more likely to sell out of those speculative investments when the volatility gets to be too much to stomach. And as a result, they may never see those crazy high returns that others may have received. Depending on when they bought and sold, they may not actually see any positive returns at all. Again, these are more speculative investments. So given that, diversification, while not necessarily always being the quickest possible route to financial independence, still may be the most practical in reality for a large portion of the population. And that's why it's so widely recommended. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.